Thank you for joining us and welcome to Business Incorporated. I'm Chimize Obi Iwagu. We'll begin the show with the market numbers and starting here in Africa. The NSE index continues its bearish trend as the index shed 3.87% at intraday. In South Africa, the JSE index added 0.10%. The EGX 30 in Egypt gained 0.39%, while Kenya closed positive on Tuesday. And in the Middle East, most major markets were negative at intraday, except for the Qatari index, which gained 2.14%. In Saudi Arabia, the market lost 2.44%. Over in the UAE, Dubai's index lost 1.04%, while the Abu Dhabi index shed 0.64%. And in Europe, markets advanced this morning as investors continue to watch the spread of the coronavirus, oil prices, and of course, geopolitics. All right, let's talk to my colleague there, Chelsea Dulani, to see what more is happening there. Well, Chelsea, good afternoon. European stocks are back on the defensive today as concerns over the impact of coronavirus continue to weigh. Are investors disappointed by the U.S. plans for fiscal stimulus?
Yeah, I think investors are broadly disappointed with all of the stimulus plans that are coming out right now. If you look behind me, the DAX started out quite strong today, but it's just been steadily declining, and now it's just up a hair, about 0.3%. I think a lot of investors had been expecting the U.S. to make an aggressive move towards emergency stimulus, and what we saw yesterday was a much more contentious outlook for that. The U.S. has said, the Trump administration has said that they would like to cut payroll taxes, which would be a really big stimulus for the U.S. economy. It's estimated to cost about $700 billion. That's about the cost of bailing out the U.S. banks during the financial crisis. But there is a lot of political division within the United States right now, and that's really spilling over into these negotiations. So, but there's both Republicans and Democrats aren't supporting the payroll proposal, and there are a lot of other proposals out right now. But it's clear there's just no political unity around a stimulus measure right now. So it could take longer than investors had really been hoping for to really come to fruition.
Now, Saudi Arabia is escalating its oil price war with Russia that led to a 30% plunge in crude on Monday, with the kingdom now saying it will pump 13 million barrels of oil per day. How are the oil stocks reacting?
Oil is still very volatile. After the big 30% sell-off on Monday, we did see a bit of a recovery yesterday because of some comments from the Russian oil minister that sort of indicated that Russia and Saudi Arabia could soon be back to negotiating over production cuts. But this move from Saudi Arabia today to up oil production to 13 million barrels a day is certainly an escalation in this war. The Saudi Arabian oil company, Saudi Aramco, had only been pumping about 9.7 million barrels a day in February. So this is just a really huge increase. And that's going to put a lot of pressure onto oil markets. We did see quite a sell-off in oil earlier today. The prices had been up. Now they're down about 3%. So I think investors are having to take the threat of a price war more and more seriously.
And in mainland China, stocks have been on the rise in recent weeks, even as global markets have been in turmoil. What's behind investors' rising optimism on China?
Investors are really seeing the light at the end of the tunnel for China. China obviously has been dealing with the coronavirus outbreak all year, and it's starting to see at this point some signs of success. So they've seen a huge drop-off in the number of new cases. They're only reporting about 20 a day. And they're also slowly getting back to work. So even in Wuhan, the area where the coronavirus outbreak originated, they're sending people back to work starting now, basically. So that's really helping investors believe that the Chinese economy is going to be up and running again, while all these other countries are really at the beginning of dealing with the coronavirus outbreak and the implications that has for the economy.
All right, thank you very much, Chelsea, for those updates. And in the UK, the Bank of England all of a sudden cut its interest rate today in the wake of the coronavirus outbreak, the first unscheduled rate change since the financial crisis. Let's get more more update from Juliana. Hello, Juliana. Good afternoon. What more reaction are you getting from the streets of London on the sudden decision by the Bank of England to cut interest rates, particularly from the markets?
Good afternoon, Chimaze. Well, what a week it's been in Britain for the economy. Yes, as you said, just in time for his departure, Mark Carney, the outgoing governor of the Bank of England, decided to cut interest rates on a pretty historic day, the day that Rishi Sunak, who literally is giving his budget to Parliament, they decided to cut it by half a percentage point. And that's really to try and support the budget, to support the government. Threadneedle Street and Downing Street are working very closely together because there are fears that COVID-19 could become a much more serious issue here in the UK than it has been. Of course, we're seeing what's happened in Italy. 60 million people have been quarantined, have been shut down, and essentially the entire economy of Italy has been shut down. So to mitigate against anything literally crumbling the British economy beforehand, the Bank of England have decided to take this drastic step to pump billions back into the economy just to keep it afloat. Mark Carney did give a news gathering speech alongside his successor, Andrew Bailey, at about 9 a.m. local time. They did say that a vaccine is on its way, but they do expect there to be a hard shock to the economy in the meantime. And that's exactly why they've done it. As soon as they've done it, the FTSE did climb 2.2%, but we have had some other big news coming out of the UK, and that's that GDP in January was flat. It's also flat in the 3 months leading up to January. So some of the gains in the morning are gone. The all share at the moment is up 0.71%. The FTSE 100 is up by 1.06%, and the FTSE 250 is up by just over 1%. The pound up on the dollar slightly at the moment by 0.11%, down on the euro by 0.32%, and down on the Japanese yen by 0.54%, Jimmy.
All right, while the bank's package of measures might help businesses, the question many would ask is, what does the bank's rate cut mean for individuals like you and I?
Well, gosh, what it means is that potentially we can stay in our jobs. Potentially we'll be able to get statutory sick pay, and the economy will still keep afloat. This measure really is to help the small to medium-sized enterprises here in the UK and in the West, particularly here in Britain. It's the small to medium-sized businesses that are the engine of the economy, and they have struggled over the past 3.5 years with Brexit and not employing people. The confidence of businesses has been historically low. We then got that monumental election victory from Boris Johnson, and we finally got Brexit done. And, Brexit is now no longer the discussion point at dinner tables. It's COVID-19. And there are concerns that if there is a similar shutdown, like we've seen in Italy, then businesses here in London and in the wider parts of the United Kingdom wouldn't be able to cope. That means asking staff to leave without pay. And so this is what it's doing. This interest rates cut, I think, for the first time in a long time, is really trickling down to everybody. And I definitely get a sense from what's going on in the environment in the UK that people are taking this seriously, and they're realizing that, this could mean, less money in their pockets at the end of the month.
All right, talking about the budget, what's the update on that? Chancellor Rishi Sunak's budget.
Well, he's given it right now, Chimmy. I can't, get on my phone or look to the telly to give you details, but one thing I do know is that, of course, it's an emergency budget. Again, it was supported by the Bank of England, Threadneedle Street today, just to try and ease the pressure. Boris Johnson, the Prime Minister, has already promised £90 million into trying to find a vaccine. But, it's a budget of two halves. Of course, Boris Johnson made some historic pledges to some parts of the United Kingdom that haven't seen the infrastructure that we've seen in London and the South East. £500 million is about the number that was promised to digital infrastructure in roads, and they would still want to do that. But of course, the majority of this budget is going to have to go to trying to curb this outbreak. I think £1 billion is going to be put into a fund for businesses, for small to medium-sized businesses that can prove that COVID-19 is affecting them. They'll be getting that money. Apparently, that money is not supposed to be given back, and there will be other measures. It's a shame I can't tell you all this detail now as I'm talking live to you. He's talking live, but certainly tomorrow morning when I speak to Eve or Bissy, there'll be a full update, Chimaze.
Absolutely, absolutely, Juliana. We're looking forward to getting those details from you. Enjoy the rest of the day.
Thank you, Chimaze.
Right. Okay, stocks in major Asia-Pacific markets tumbled today as investors continued to watch for developments around government stimulus, with the coronavirus continuing to spread. Stocks in Australia also saw sharp declines as the ASX 200 dropped 3.6%. South Korean stocks were also among the biggest losers among major markets regionally, with the Kospi plunging 2.78%. The Kosdaq index fell 3.93%. Shares in Japan also fell on the day as the Nikkei 225 slipped 2.27%, while the Topix index declined 1.53%. Interestingly, mainland Chinese stocks slipped today by the close, with the Shanghai Composite 0.94% lower and the Shenzhen Composite shed 1.48%. In Hong Kong, the Hang Seng index was 0.75% lower as of its final hour of trading. And U.S. stock futures fell sharply this morning, pointing to another volatile session on Wall Street. As of 5 a.m. Eastern Time, Dow Jones Industrial Average futures indicated a loss of nearly 500 points at the open. Futures on the S&P 500 and Nasdaq 100 also pointed to losses. Market players are also looking at fiscal and monetary policy responses. In terms of data, there will be monthly consumer price figures at 8:30 a.m. Eastern Time, and federal budget numbers are due at 2 p.m. Eastern Time. There are no major earnings reports scheduled for Wednesday. Zimbabwe Finance Minister Michelin Kube says the country will adopt a managed float exchange rate regime. According to him, Zimbabwe is abandoning strict control of foreign exchange by the central bank as it battles a growing economic crisis. The central bank has controlled the interbank forex trading market, which was introduced in February 2019, but failure to free it up has widened the gap between the black market and official exchange rates. And South African regulators are stepping up efforts to break the oligopoly of the country's top auditing firms after accounting scandals involving two of the big four failed to do the job for them. The nation's largest publicly traded companies are reluctant to switch to mid-term firms out of concerns they may not be able to handle complex operations often sprawled across Africa or further abroad. That's spurring smaller firms to scale up their businesses and hire teams in anticipation of new rules aimed at dismantling the dominance of PwC, Deloitte, EY, and KPMG. The regulator is now developing guidelines on how firms can perform joint audits to upskill mid-tier companies, while also encouraging smaller auditors to combine their operations or cooperate to handle larger mandates. And Congo Republic aims to reach a deal with energy traders Glencore and Trafigura to restructure a $1.7 billion debt before a meeting with the International Monetary Fund in April. The Director General of the National Oil Company says lawyers for Congo Republic are working with representatives of Glencore and Trafigura to get all the parties reach an agreement before the next IMF review. In July last year, the IMF agreed a $449 million three-year lending program, but only $45 million has been disbursed, with other funds subject to semi-annual reviews. A requirement for further disbursements is the restructuring of Congo's oil-backed loans from the Swiss traders.